Hey there, fellow investors. Welcome to my channel where I track my net worth and speak to you about various investments. In today's video, I'm going to speak about my major taxable investments. Specifically, I'll be going over 4 popular ETFs that I invest in: VIG, SCHD, QQQ, and SPHD. So let's get started. Before I get into the ETFs, the app I am using is called Stock Events. It is downloadable from the Apple iStore. It is free, but to get additional features you do have to pay money. But overall, it's a great app if you want to consolidate all your investments into one area so you can track it more easily. It's great if you have multiple investments at different brokerages. So for the first ETF, I'm going to speak about an ETF called VIG, which is the largest holding I have by percentage and also by value. VIG stands for Vanguard Dividend Appreciation ETF. The ETF focuses on companies that have a strong history of increasing their dividends over time. VIG aims to provide investors with stable income and potential capital appreciation. So you basically get a combination of dividend growth, stable income, and the great benefit of also growing your capital. It's a great option for those seeking exposure to dividend-paying stocks from well-established companies. So I'm going to go to the fund page here and show you its top holdings. As you can see, all the holdings are pretty much well known and they're stable. It invests in various sectors. So you get tech, obviously, you get industrials for energy, you get healthcare, banking. Overall, great ETF. It is extremely well diversified, and if we compare this to the general holdings of the S&P 500, as you can see, there is a bit of difference here. So this is the holdings for the S&P 500 compared to VIG here. As you can see, it does a switch for Apple and Microsoft being the first and second respectively. VU doesn't even have any major holdings of ExxonMobil, but VIG has that as its third. Other companies like United Healthcare is much lower on the list. I guess that the fund overall seeks more to invest in more established, well-rounded companies. As you could see, like here, Google isn't even included in VIG, obviously, because it doesn't really pay a dividend at all, unlike as it's included in the S&P 500 and Meta. So if you're kind of concerned with an overexposure to big tech, or if you think that big tech in the S&P 500 may perform a little bit worse or is a little bit too volatile for you, VIG is a great option for an alternative holding that probably will over time perform just as well as the S&P 500, but with reduced volatility. If you're kind of concerned, like with Nvidia here, this company has had a massive run up recently in the S&P 500. VIG doesn't even include it. So as I said, it's a great alternative to the S&P 500 if you want a bit more stability. So next up is SCHD. It is my second largest dividend ETF that I hold. It is the Schwab US Dividend Equity ETF. It is somewhat similar to VIG in that it focuses on dividends. However, SCHD takes a slightly different approach. It selects stocks based on various fundamental factors such as cash flow, earnings growth, and dividend yield. The ETF is a great choice for investors looking for both income and potential long-term capital appreciation. So as you could see, its dividend is quite a bit higher than VIG's, and it doesn't focus as much on like higher growth potential companies. Here's basically the comparison between VIG and SCHD. As you could see, the fund holdings are like very different overall for both ETFs that are dividend-paying ETFs. VIG, I believe, has a screening method that prevents dividend-paying companies that pay over 3%, I believe. So they won't include those companies, where SCHD has no restriction on that. This is kind of why I'm comfortable with holding both of these at the same time, because even though they're both dividend dividend-paying ETFs. There is very little overlap between both of them. As you could see, there are some commonalities. Home Depot is in both of them, but overall, very different. So if you're looking for maybe a dividend ETF that focuses more on dividend yield rather than appreciation, SCHD is a great choice. This is an ETF that became extremely popular over the past few years when it comes to dividend investors. So it could be used as kind of like an individual ETF to buy if you want it as your only holding and just go for these yielding companies. So you basically just set it and forget it. It's very diversified over many industries, and overall I think it has only 100 holdings, so it's not as well diversified, but I don't think you can really go wrong with this ETF overall because 100 companies really is diversified enough. I mean, overall this is probably going to be just as volatile, if not less volatile than VIG, so it might be a great alternative, or it might just be a great complement like what I have. I have both of them, of course. So that's another ETF to look out for if you want dividends and you want maybe a little bit a better yield than just VIG hold. If we look at the composition of SCHD versus the S&P 500, as you could see, like very different. So the top holdings of SCHD here, and then the Vanguard S&P 500 ETF is here, VOO, and just pretty good contrast. So again, like very limited growth, like companies when it comes to like the standard, like no Microsoft is in the top holdings here. VOO doesn't even aim to have like any Coca-Cola or Pepsi or anything like that, while this obviously does. So the Coca-Cola and Pepsi, it doesn't really have any communications in the top except Facebook, but Facebook of course is quite a bit more volatile. You can argue that Google is a communication because they own this platform, YouTube, but SCHD focuses on kind of like the more generally known telecommunications. So if you don't want to do either VOO, you can go to SCHD. Maybe you don't like the volatility of VOO, or maybe you just want, again, a higher yield. It's a great contrast to VOO, and it's even a great contrast, like I said, to the Vanguard Dividend Appreciation ETF based on its financial selection methods. So another one of my large holding is the Invesco QQQ Trust. It is a great ETF if you're looking for growth. It basically tracks the performance of the Nasdaq-100 Index, which includes 100 of the largest non-financial companies listed on the Nasdaq stock market. The ETF offers exposure to leading technology and growth-oriented companies like Apple, Microsoft, and Amazon, and many others. QQQ is quite popular among investors seeking exposure in the tech sector. So here are its main holdings here that I am going to go over. Let's see if I can find it really quickly, get the fact sheet. And as you can see, if I scroll down a bit, so Microsoft, Apple, Amazon, Nvidia, Tesla, Google, Facebook, now Meta, Broadcom, and Pepsi. So if you're looking for like growth-oriented companies or companies specifically in the tech sector, if you expect it to outperform, maybe you don't really want as many consumer staples, or you're not concerned with volatility, you believe in technology strongly, you think that technology is just going to go up and up and up, QQQ is a great investment for you. It is overall pretty well diversified with quite a few holdings, but just be mindful that about 25% are in two companies, which are Microsoft and Apple. Some might say that that's fine because those are great companies and they're not going to go anywhere. I would agree with that, but it's still not a great idea to have too many eggs in one basket. If we look at these holdings, it is kind of contrasted to the S&P 500. There's quite a few holdings that are similar. but it's just weighted more heavily. So as you could see, Apple and Microsoft are about 13% of the Vanguard S&P 500 fund, where, as we went over, the other one is about 25%. And it's contrasted because it's obviously like overexposed to technology. Over the past few years, obviously tech has done very well, which drew a lot of attention to the ETF. People have gone leveraged on this by buying the TQQQ ETF, which is a triple leveraged fund, which basically brings risk and volatility to the next level. But some people would rather choose this over Vanguard because they want to get rid of things like ExxonMobil, United Healthcare. They just don't believe that these companies are going to be outperformers, and they just don't care about volatility. Obviously, with me, I choose to hold it, but it is a relatively minor portion of my overall holdings. It's about as much as SCHD overall. So I don't mind holding it because it's a great complement, because I do have another dividend ETF, another dividend ETF, and another dividend ETF. So I want it to kind of get away from just, I guess, value, or maybe not so much value, but just dividend ETF. So QQQ is a great complement to my holdings, because basically none of these other ETFs, except maybe VIG a little bit, has those companies. So I thought that it would be a great holding because there's not a lot of overlap overall, and I wanted a little bit of growth in addition to the dividends. So lastly in my main holdings is a fund called SPHD. It is the Invesco S&P 500 High Dividend Low Volatility ETF. The ETF aims to provide investors with a combination of high yield dividend stocks and low volatility. It selects stocks from the S&P 500 Index that have historically paid high dividends with lower price fluctuations. SPHD is a suitable choice for investors seeking income and potential less risk compared to high dividend strategies. So kind of like the ETF summary kind of sums it up quite well. It basically picks the top 50 dividend yielding companies in the S&P 500, which are typically well-established companies that have a long track record of paying high yield dividends, and it also screens for volatility. So if you're worried about volatile markets, you can invest in this ETF. For most people, I would caution against investing in this ETF because it doesn't really offer a whole lot of growth. I'm going to get into the holdings that it has here and kind of show you what it doesn't have. So as you could see, none of these none of these stocks you would consider like growth companies. Like AT&T, certainly not a growth company. Verizon, certainly not a growth company. Altria, tobacco company, not a growth company. And I believe it also has Philip Morris, also not a growth company. So it's really not screening for these growth companies or capital appreciation. It's, again, as the fund description said, specifically high dividend, low volatility. I don't believe that any of these companies are going to go anywhere anytime soon. Like even Altria and Philip Morris, like they're just going to get into smokeless tobacco as tobacco use decreases. I think they're also going to get into marijuana too as that becomes more legal through the United States. So I highly doubt that they're going to go anywhere anytime soon. Neither is AT&T. We all pay our phone bills. Neither is Verizon. They're just going to stay around, and again, they're not going to grow anywhere, but they're just going to keep paying their dividends and give you a dividend from those cash flow every month. So that's a great thing too. Another reason why I picked this ETF, because this ETF pays you every single month, unlike VIG and SCHD. So if you're looking for a monthly payer and you're not really that concerned with the growth aspect and you might be closer to retirement, or you just have a bunch of money and you're just looking to just get income off of it. Say you got $1 million and you want to just set it and forget it and pay it every month, this ETF wouldn't be a bad choice. Some may argue, of course, that SCHD is going to be better because, in all honesty, it does have more quality companies. It does have a pretty high yield just as SPHD, but it doesn't really have that downside of investing in stagnant companies. So some people would definitely take SCHD over SPHD, and I would probably recommend that too. If I were to tell you the weighting, I think my weighting through my investments are like obviously a small portion. Probably I want to say like 10-15% SPHD or something like that, and then majority is going to be over SCHD. So even I don't have too much faith in the capital appreciation of SPHD. It's all about that monthly dividend distribution. Every month I'm getting that dividend, reinvesting it, putting my own money in, reinvesting, and then that kind of just goes to volatility. So more dividends, and I really don't have to worry. It's more so about a psychological factor than it is about maybe an investment thesis. I don't think, again, that these companies here are going to perform significantly better than these companies. It's just the fact that I wanted a little bit more volatility resistance, and I wanted another dividend ETF that basically complemented this, and there wasn't a lot of overlap. So as you could see, I don't think there's really any overlap between VIG, SCHD, and then SPHD. So all of my dividend companies, my dividend ETFs, have minimal overlap. There is a little overlap here with Verizon, and I think in the lower end there is overlap with maybe some other companies that are insignificant percentages overall. Maybe like there might be like 5% overlap overall between these three ETFs, which is why I don't really mind holding three ETFs that have a similar purpose, because as I just explained, very minimal overlap between all three, so I get the benefit of diversification while still holding these ETFs. Alright, and so you may have sat there and listened to the entire thing and was like, okay, like, what is this guy's point? Why is he doing this? Why not just invest into the Vanguard S&P 500 Index and like set it and forget it? Like, why is he just like having all of these ETFs? This seems like over diversification. There's no point. He gets just as much diversification with the S&P 500. Well, the thing about the S&P 500 is that it's not as well diversified as most people think that it is. So in this like 10 minutes, hopefully if I did this right, I put together all of my holdings, like, and the main holdings of these. So the Vanguard ETF that I have, the VIG, Vanguard Dividend Appreciation ETF, constitutes about 46.4% of my total holdings, and then within that, Microsoft comprises about 4.6% of that fund. So my total invested in that fund is 2.16% overall. So you kind of see this like so on and so forth. So Apple constitutes about 4.27% of the fund. The fund's 46.4%. So my overall holdings in that specific ETF of my total fund, my total portfolio, would be about 2%. So I did that and added all of those together into one. So I basically added this and this because that's a Microsoft holding. I added Apple up together because it's all one Apple. And I got my portfolio. So of my portfolio, Microsoft constitutes about 4.56% and Apple constitutes 4.34%. If we contrast that and look at the S&P 500 ETF, it's actually a lot a lot worse off. Like, it's a lot less diversified. So as you could see, my portfolio, Apple, it's only about 4.34%, but with the Vanguard S&P 500 ETF, it's 7.2% of the overall holdings of that index. So when you're investing into the S&P 500, you're investing 7.2% of your money into Apple, 6.53% into Microsoft, and then so on and so forth with Amazon, Nvidia, and Google. So if you basically look at the Vanguard S&P 500 ETF, pretty much like a good portion of your money is going to these tech companies. So if we look, we get a total of the top 5 holdings is about 20.1%, 20.2% just into these tech holdings. And for me, that's pretty much like too tech heavy. I think tech is a growing industry, but I don't want that much of my money into these companies. So I think overall, like most people would say, oh yeah, the S&P 500 is so diversified. It's really not that diversified. So kind of to counter that, like a little bit less in those positions, and my other holdings that are top aren't even tech companies. We have Exxon and Mobil, United Healthcare, and Johnson & Johnson that are constituting the top 5. So then I basically have all of the other holdings, 6, 7, 8, 9, 10, so on and so forth, that also provide extra diversity. And if we look at, like my SCHD, like these are so much different than the funds that are, tracking the S&P 500, because those don't include these small little guys that really nobody thinks about to lessen the volatility. Sometimes when the market goes down so much, these companies do well because they're seen as safe havens, unlike these high-flying tech companies. And again, like no Pepsi, no Cisco, no Coca-Cola, no Merrick. It's just so tech heavy, and I don't enjoy that too much. And I also get the added benefit of being able to, switch back and forth. Maybe, hey, I think tech is going to do great. I could just invest more into the QQQ portion of my fund, and then tech becomes a greater weighting. Maybe I think the market's going to do maybe worse. Maybe I think the dividend, the well-known dividend companies that have like financial screenings against them is going to be like better, and so on and so forth. I get a greater dividend yield than the S&P 500 with lower volatility. I might underperform slightly, but I'm okay with that overall, because again, I get to have less volatility, I get those dividends, and I sleep a little bit better at night, because sometimes when the S&P 500 does like poorly, maybe it's a down day of a few percent, or like, let's not hope it's a few percent, maybe like 1%. My portfolio might only go down like 0.5% because it has these companies that are like better with volatility. So where does that get me overall with my holdings? So I'm kind of just going to go in here and just show you. So I have about 64,000 invested currently, and I want to show you my dividends. So currently I'm annually collecting about $1,500 with a yield of 2.34 and a yield on cost of 2.55. If we look at the S&P 500, we get a dividend yield of 1.6%. So I mean, like, clearly I get about a 1% more for my dividends with more diversified holdings, which I'm still very comfortable with. Alright everyone, that's going to be it for today's video. I hope that you did gain some insights to it. Maybe you thought of some portfolio ideas, maybe you thought of some things that you want to do, maybe things that you didn't want to do, maybe you didn't like my portfolio, or maybe you liked it. Either way, I hope it helps you out and gain some insights. If you enjoyed the video, please don't forget to like and subscribe. It would be a great thing for you and this channel as I go over my net worth and keep you all updated. You guys can use this video as a reference point. So thanks again, and have a great day.